Systems for accounting for inventory, periodic system and perpetual system. Periodic system. How does it work? At the beginning of the period, a physical count is taken. All purchases are recorded. The goods available for sale are the purchases plus the beginning inventory's physical count. At the end of the period, another physical count is taken to get the ending inventory. With such information, we can calculate the goods sold as previously illustrated by subtracting the ending inventory from the inventory available for sale. Periodic system, pros and cons. The periodic system is easy and simple to apply. However, it does not provide information about the inventory during the period, including the number of units for each product and the cost of each unit. How are the merchandising transactions recording using a periodic accounting system? Let's assume that a business bought product X from a supplier for $1,000. The terms of payment is 210 net 30. When goods are purchased, they are recorded as purchases. There is no inventory account in this case. So what does 210 net 30 mean? It means that the business could take 2% discount if it paid within 10 days. Otherwise, it would pay the whole amount in 30 days. If the business pays the amount within the discount period, which is 10 days, it would take a $20 discount. The entry would be debiting the accounts payable by the full amount as the business owes nothing to the supplier after paying the amount due. Then purchase discount is credited by $20 and cash is credited by the rest, which is $980. If the business didn't pay within the discount period, it would pay the full amount. In such a case, there is no discount, and the accounts payable is debited and the cash is credited for $1,000. Let's now assume that the business sold 12 units of product X to customer A for $80 each with terms of payment $315 net 45. As the business is using the periodic inventory system, it will record sales only. It will not record any reduction in inventory. Accordingly, account receivable for customer A's account is debited by $960 and sales revenue is credited by the same amount. The terms of payment in this case means that the business is ready to give the customer a discount of 3% if payment is made within 15 days. Otherwise, the full amount should be paid within 45 days. Now, let's assume that the customer paid within the discount period. The discount is equal to $29. The accounts receivable is credited by $960 as the customer does not owe the business anything after payment is done. Cash is debited by $931 as cash is received. Sales should decrease by debiting it by the amount of the discount as the sales are now less. However, this is not the correct practice. If we do that, we won't know how much the original sales is and how much the discount is. That is why we debit a sales discount account, which is a contra sales revenue account. Its normal balance is debit and it increases by being debit. The sales discount is later subtracted from the sales to get net sales. By this method, both the amount of the original sales and the amount of the sales discount is known. So sales discount is debited by $29. If the customer didn't pay during the discount period, no discount is granted and the full amount should be paid. In such a case, cash is debited by $960 and account receivable is credited by the same amount. At the end of the period, an inventory physical count is taken to see the amount of inventory that is not sold. If we know the amount of purchases and the beginning and ending inventory balances, we could deduce the cost of goods sold as previously illustrated. In our example, assume that the business purchased $15,000 of goods before the $1,000 purchase which is mentioned in this example. So the total purchases balance is equal to $16,000. The beginning inventory is equal to $10,000, which was calculated based on the previous period's physical count. Also assume that the physical count showed that there are 3,000 worth of goods on hand. To record the cost of goods sold and to update the inventory account to reflect the new balance of the ending inventory, we need to close the beginning balance of the inventory account by crediting it by $10,000, and also closes the purchases account, which has a debit balance, by crediting it by $16,000. The addition of these two balances represent the goods available for sale of $26,000. Notice that the inventory account is equals to 0 at this point. To update the inventory account with the new balance, we need to debit it by the result of the physical count, which is $3,000. Subtracting the ending inventory of $3,000 from the goods available for sale, we get the cost of goods sold, which is equal to $23,000. To record the expense, cost of goods sold is debited by this amount.